On January 1st, 2026, something changed in the silver market that most people still don't understand. There was no alert on your phone, no red banner on financial news, no expert panels arguing about it on television. But from that day forward, the global silver market stopped behaving like a normal market. While most investors were distracted by violent price moves, China quietly rewrote how silver leaves the country. And once you understand what they did, the recent crash stops looking random. It starts looking intentional. China didn't touch the price. They touched the supply. Before January 1st, silver exports from China worked the way most people assume markets work. If a refinery could produce silver that met standards, it could sell it abroad. Big refineries, small refineries, flexible suppliers that could step in when demand picked up. That flexibility mattered. It's what kept shortages from showing up quickly when demand surged. That system is gone. Starting January 1st, China moved silver exports under a permit-only system. On paper, that doesn't sound dramatic. Governments regulate exports all the time. But the details are where everything changes. Only companies that produce more than 80 tons of refined silver per year are allowed to even apply for an export permit. 80 tons. That single requirement wiped out most exporters overnight. And out of all eligible companies, only 44 were approved. 44 companies now control nearly all legal silver exports out of China, and every one of them is tied to the state. These companies don't respond to price signals the way normal businesses do. They respond to policy. If Beijing decides domestic industry comes first, exports slow. If priorities change, permits change. This isn't speculation. This is how China already operates in other strategic materials. Now here's why this matters more than people realize. China produces roughly 21,000 tons of refined silver a year. About 4,000 tons of that has historically gone to the rest of the world: Europe, the United States, Japan, Korea, solar manufacturers, electronics firms, auto suppliers. Analysts expect exports to fall by 30 to 50% under the new system. That means somewhere between 1,200 and 2,000 tons of silver per year simply won't reach global markets. That's not a rounding error. And it's not something you fix quickly. Silver mining doesn't work like oil production. Most silver comes as a byproduct of other metals. You don't just mine more silver because the price went up. If copper or zinc production doesn't expand, silver doesn't either. So when supply tightens, it stays tight. Now layer on what was happening inside China at the same time, because this is where the crash starts to make sense. China has only one major exchange-traded product that gives everyday investors exposure to silver. During the rally earlier this year, money poured into it. Assets tripled in a short window. Demand got so intense that the trading price of the fund completely separated from the value of the silver it actually held. People were paying far more than the metal was worth just to get exposure. That wasn't greed alone. It was desperation. China's real economy is struggling. Property is weak. Business investment is weak. Banks are lending less. But liquidity keeps flowing through the system. There's a lot of money with nowhere productive to go, so it rushes into markets. When silver prices turned down, the structure of China's market made things worse. Daily price limits meant the fund couldn't adjust normally. It hit maximum losses day after day. Selling became trapped. Panic built. The fund dropped more than 40%. And even after that collapse, it still traded at a massive premium to its actual value. That tells you this wasn't a normal market correction. It was forced selling inside a broken structure. And that forced selling didn't stay contained. It spilled into global markets. Futures liquidated. Margin calls hit. Screens went red. That's the crash everyone saw. But here's the critical point. None of that changed how much silver exists. None of it increased supply. None of it reduced long-term demand. It just flushed leverage. At the exact moment China was quietly restricting exports. That's why the crash is misleading. It looks like a collapse in confidence, but underneath it, the physical market actually got tighter. Western buyers didn't stop needing silver. Solar didn't stop. EV production didn't stop. Data centers didn't stop. Defense contracts didn't stop. But the flexible Chinese suppliers they relied on disappeared. What remains are 44 state-connected exporters whose priority is domestic industry, not global balance. That changes behavior. Companies don't wait until shelves are empty to react. They start ordering earlier. They start building buffers. They start paying premiums to guarantee delivery. Those decisions don't show up on price charts immediately. They show up months later, when availability tightens quietly. This is why focusing only on short-term volatility misses the real story. The screen price can fall because paper positions unwind. Physical reality moves slower. And when the two drift apart, price eventually snaps back towards supply constraints. That's where this market is heading, not in a straight line, not without more volatility, but with a foundation that looks very different than it did before January 1st. What makes this moment tricky is that the people who feel the impact first are not investors. They're manufacturers, and manufacturers don't talk on Twitter. They don't ring bells on TV. They quietly change behavior. When supply becomes less reliable, they don't wait for confirmation. They hedge it. They order earlier. They overorder. They build inventory even when it hurts margins, because shutting down a factory hurts more. That's how shortages begin, not with headlines, with small decisions repeated across thousands of companies. Silver sits in a strange place in the economy. It's not just an investment metal. It's a working metal. It moves through solar panels, electronics, medical equipment, cars, data centers, power grids. It's everywhere, but invisible. And that invisibility is part of the problem. When oil tightens, everyone notices. When food tightens, everyone notices. When silver tightens, it shows up as delays, cost creep, and supply adjustments buried in earnings calls. Now imagine being a procurement manager in Europe or the US. You've spent years sourcing refined silver from Chinese suppliers who could respond quickly. Prices go up, they ship more. Prices fall, they ship less. A normal market. Now those suppliers are gone. Instead, you're dealing with a smaller group of exporters whose priority isn't speed or price. It's policy alignment. That changes negotiations completely. You're no longer negotiating with a business that needs your order. You're negotiating with a gatekeeper who can afford to say no. And once buyers realize that, they stop playing spot markets and start locking in supply. That's when paper prices stop telling the full story. Because futures markets reflect marginal trades. Physical markets reflect necessity. This is why crashes like the one we just saw often fool people. The paper market flushes excess. Confidence drops. Commentators declare the story over. But the physical market doesn't reset. It just keeps tightening quietly. Now layer in one more factor that almost never gets discussed in public analysis. Silver demand is becoming less flexible. 10 years ago, silver use could be adjusted more easily. Manufacturers had room to substitute. Designs were simpler. Volumes were smaller. Today, silver sits at the core of energy transition infrastructure. Solar panels require it. EVs require it. Grid upgrades require it. Data centers require it. These aren't luxury uses. They're strategic. That means demand doesn't disappear just because price swings. It gets deferred. It gets hedged. It gets stockpiled. And stockpiling pulls supply forward. This is where timing matters. China didn't restrict exports after shortages appeared. They did it before. That's what makes this strategic instead of reactive. It mirrors what they've already done with other materials. First, dominate production. Then consolidate control. Then restrict access. Then let the rest of the world scramble. And while the world scrambles, China builds reserves. That's why the export rule wasn't announced loudly. Loud announcements create reactions. Quiet rules create advantage. Now let's talk about why the crash itself may have helped this process. Volatility shakes out weak hands. It forces liquidation. It discourages speculative hoarding outside of China. It resets sentiment. At the same time, it lowers prices for anyone buying without leverage. If you're a strategic buyer with long horizons and deep pockets, volatility is not a threat. It's a tool. This is why price crashes don't always signal weakness. Sometimes they signal transfer. Metal doesn't vanish during a crash. It changes ownership, from leveraged players to patient ones, from speculators to planners, from hands that panic to hands that wait. Now zoom out and look at the broader backdrop. Governments everywhere are talking about supply chain security, strategic stockpiles, domestic manufacturing, critical minerals. Silver rarely gets named directly, but it doesn't need to be. It's embedded in all of it. And once a metal becomes strategic, price discovery changes. It stops being purely financial and starts becoming political. That doesn't mean prices only go up. It means prices stop behaving politely. They overshoot. They undershoot. They move in jumps instead of trends. That's the environment silver is entering. Which brings us back to the crash. If this were a pure demand story, prices would stay depressed. If this were a technological substitution story, prices would grind lower. But this is a supply control story colliding with leverage. Those stories resolve upward over time, but painfully, not in straight lines, not without drawdowns. That's why most people miss the move. They focus on the noise instead of the structure. And structure always wins. Now here's the uncomfortable truth. The market doesn't need everyone to understand this. It only needs enough large buyers to act on it quietly. Once enough long-term contracts get signed, once enough inventory gets locked away, spot markets thin out. And thin markets move violently. This is where retail investors often get hurt, not because they're wrong on direction, but because they're wrong on timing and vehicle. Paper instruments feel safe until liquidity disappears. Physical feels boring until it isn't available. That difference matters most during transitions. And we are in a transition, not from low prices to high prices overnight, but from abundance to control, from flexibility to permission, from open markets to managed flows. Those shifts don't announce themselves with bells. They show up in footnotes, permits, and quiet policy changes on holidays. January 1st was one of those moments. Most people missed it because they were watching charts. The chart will catch up later, so the question now isn't, did silver crash? Because that already happened. The real question is what happens after the crash, when the structure underneath the market has changed. That's where most people get it wrong. They assume markets reset to the old normal. But markets don't rewind. They move forward with new rules. And one of the biggest rule changes just happened quietly. From here, the signals that matter are not candles or headlines. They're behavior. First, watch delivery behavior, not price behavior. If supply were truly loose, buyers would relax. Orders would slow. Inventories would rebuild. Premiums would collapse everywhere. But if supply is tight, something different happens. Buyers rush to secure metal even during price weakness. They accept wider spreads. They stop waiting for better prices because availability becomes the priority. That's not bullish emotion. That's operational necessity. Second, watch regional divergence. When paper prices fall but physical premiums stay firm or rise in certain regions, that's not a glitch. That's stress. It means metal is needed where it's being used, not where it's being traded. Those gaps tend to widen before prices move, not after. Third, watch policy silence. When governments make strategic moves and then stop talking about them, it usually means the move worked. China hasn't walked back the export rules. They haven't clarified them. They haven't softened the language. That tells you this wasn't reactive. It was intentional, and intentional moves tend to stick. Now let's address the emotional part, because that's where most investors actually lose. Volatility messes with decision-making. Big red days make people want certainty. Big green days make people want speed. Both are dangerous. Silver doesn't reward impatience. It punishes it. This market has always been designed to shake people out before the real move. That's not conspiracy. That's structure. Thin markets plus leverage equal violence. And when leverage leaves, what's left is fundamentals. That's when pricing gets honest. But honest pricing doesn't mean calm pricing. It means prices that reflect scarcity instead of speculation. That process is messy. There will be more fake-outs, more rallies that fail, more drops that feel unfair. That's how transitions look in real time. Now here's the part people don't like to hear. If this tightening continues, the next major move won't start with excitement. It will start with boredom, sideways action, choppy weeks, people losing interest, commentators moving on. That's when long-term positioning usually happens. Because scarcity doesn't announce itself loudly, it creeps. Then one day, a large buyer can't source metal fast enough, or a manufacturer misses a shipment, or a government stockpile quietly expands. And suddenly the market remembers what it forgot. That silver is not optional. It's required. And required things don't stay cheap when supply is controlled. Now, does that mean prices only go up from here? No. It means downside exists, but it's becoming less meaningful than upside over time. It means dips hurt less structurally than rallies help. It means risk is shifting, and shifting risk is what creates long-term opportunity. This is why crashes during structural changes often end up being remembered differently years later. Not as disasters, but as transfers. From noisy money to quiet money. From leverage to ownership. From people chasing charts to people planning supply. And here's something important to keep grounded. You don't need to predict exact prices. You don't need to time bottoms perfectly. You don't need to catch every swing. You need alignment. Alignment between your time horizon and your exposure. If your horizon is short, volatility is a threat. If your horizon is long, volatility is information. And right now, the information says one thing clearly. Control is increasing. Flexibility is decreasing. And markets that lose flexibility don't behave gently. They snap. They overshoot. They surprise. That's why the biggest mistake people make is assuming the last move defines the next one. It doesn't. The structure does. And the structure of the silver market just changed in a way most people haven't fully processed yet. China didn't just adjust policy. They narrowed the exit doors. They concentrated supply. They shifted leverage. And they did it while everyone else was staring at red charts. That's not accidental. That's how long games are played. So where does that leave you? It leaves you with a choice, not a prediction. You can react to price, or you can respond to structure. You can chase momentum, or you can respect supply. You can panic with volatility, or you can plan around it. None of those choices require hype. None require certainty. They require clarity. And clarity comes from separating noise from mechanics. The noise says silver crashed. The mechanics say silver just entered a more controlled world. Those two things can exist at the same time, and usually do right before markets reprice. Not overnight, but decisively. So as this plays out, don't ask whether silver is dead or moonbound. Ask simpler questions. Who controls supply? Who needs the metal? Who can wait? And who can't? Markets always answer those questions eventually. And when they do, the answer shows up in price whether people are ready or not. That's where we are right now. Not at the end of a story, but at the quiet middle, where outcomes are decided long before they're obvious. If you've stayed with me this far, you're already ahead of most of the noise. Stay patient. Stay grounded. Watch behavior, not headlines. And I'll see you in the next one.